Times are tough for investors.
The banking regulator is cracking down on risky loans.
Interest rates up is the most likely direction they'll go.
And where the latest boom now appears to be ending.
The markets have done the heavy lifting. That's not going to work forever. Didn't work for the decade prior to that.
What's the strategy?
It's planning. And if you don't have a plan, you're investing in the dark. What's the analogy where you feel like if a ship didn't have a guide, it'll end up like miles apart? If you don't have a plan in place, you're going to end up countries apart. Because for a lot of people, it's the inability to take action, which has cost them a lot of money in this market. They just get busy. You've got kids, school coming up, and all of a sudden you've missed out on 40 to 50% of the market because you're just too busy.
What is your strategy in 2026?
The priority for me this year is to wipe off the debt completely. If you don't do it now, you won't do it.
You're listening to the Folio Property Podcast. I'm Reece and I'm here each week with my co-host Lachlan Delahunty. It's been a big start to the year 2026. Off the back of last week's episode, Lachlan, I thought we'd delve further into investment strategies for 2026. We spoke a lot about
the markets, predictions. We briefly touched on some of this strategy bit at the end, and I think let's kickstart it and really delve into what strategies you're doing. What strategies, what some of our audience doing, if we throw it out to them as well. Yeah.
And what are some types of strategies you should be, generically employing in 2026?
Yeah, and every year is going to be different, right? So first off, please, our community that we're speaking with, put in the comments your strategy for 2026. We'd love to hear what you've got planned. If you haven't thought about it already, it's a great time to do that. I think this is the time of year where you should be having a bit of a health check. We're not so busy with the day-to-day grind of life to actually check in on it. We were speaking off air, Reece, both of us checked in on this. I was on a plane 12 hours and I went through all my numbers. It was a bit of a shock because I hadn't done it for 6 months, and it's amazing what can change in such a short period of time. And yourself, you said you did a budget that you hadn't done for a while as well.
I hadn't done a while. Wife was putting a bit of pressure on to do it, and I was probably neglecting it. And once you start to do it, you're like, it is important to have that health check. And I think the reason why this episode's super important in 2026 is a lot of our listeners or viewers would have been riding some serious highs over the last couple of years with some of their portfolio that they've got as well.
Which is fantastic, right? We want to celebrate that. It's been a really good run, and that's what we want to see from our clients. We want to see them do well to give them that financial freedom, but it's also important that we don't get carried away, get too excited, because as I've said on previous episodes, everyone's an expert at a period of time in cycles. How can you de-risk it? It's checking in. It's planning. And if you're not planning, if you don't have a plan, you're investing in the dark.
Yep. Our strategies, although probably different ends, are going to be slightly similar due to our age and maybe some of the risks that we've taken on. But what other strategies are there? So, what strategies would
for 2026?
2026,
so
correct.
They're reviewing. They're either going to be in a debt reduction phase where you actually want to, like myself, we'll talk about that. You could be in a full accumulation phase where you're at that phase where you want to continue to grow your portfolio aggressively. You may go through a phase where it's you're still in that rent vesting phase and you want to expand on that. The upgrading phase we spoke about, it's okay. Well, I have been on that rent vesting stage, but I'm sick of getting pushed around and not having a place to call home. Right, we talk about the Australian dream is owning your own home. So that place where it's like, okay, I've done a lot of the heavy lifting. Now I just want to buy a home and not carry too much debt onto my primary place of residence. So that's a really good one. Might be later in your journey, Reece, where you're looking for more for cash flow. You've had to realise over the break that you're 55 and you don't want to work till you're 70. How can I get myself in a position by the time I'm 60 that I don't need to work? Okay, well, what strategies are we going to put into place? Yep. So there's quite a few. Like if we reel them off, there's 10 to 12 strategies that we commonly see with our investor group.
Okay, in terms of strategy, like you've mentioned there 6 or 7 probably, actually. Yep. There's a fair amount there. What's the importance of having one? And like we mentioned, now's a really good time to review this year, and depending on what your circumstances are and make action with it. How important is it doing a review of a strategy, and how important is the strategy?
Like I said, if you don't have a plan in place, how do you keep yourself accountable? And what's the fucking analogy where you feel like if a ship didn't have a guide, it'll end up like miles apart? What's that analogy? Do you know it?
I don't know, but keep it in.
No, like you know the analogy? It's like if the ship didn't have a map, you'd end up like 2 degrees off. You end up in a different location.
Yeah. I'll take your word for it.
Like, do you want to get
No, say it. Like, I think keep it in.
Reece, what's that analogy? If like the ship didn't have a course to be directed on and it was 2 degrees off, you're going to end up like countries apart. Yep. And the same's different with your portfolio. If you don't have a plan from where you want to get to, like you've got no control over it. It's purely down to chance. And fortunately for Australia over the last 5 years, chance has been okay. You've backed a couple of good horses, but the markets have done the heavy lifting. That's not going to work forever. Didn't work for the decade prior to that. So what's to say it's going to work for the next decade? So having a plan, having a strategy is so important. It's not to say that won't change. My strategy's changed probably 3 or 4 times in the last 5 years alone, marginally, but things change. You might, all of a sudden, family becomes really important, or upgrading becomes really important, or having exposure to debt. Over the break, I had a realisation when I did my review that, wow, my debt to income is far too high than what I feel comfortable with the life commitments I've got coming up. So you can have those reflection points, and that will change throughout time. There's periods of time where you want to be more aggressive, and there's periods of time where you want to be less aggressive. So it really depends on that individual. So it's important to check in on your numbers and see where your debt to income is, you watch your cash buffer and your LVR and your exposure to various markets. It's not until you sit back when you're not distracted. And I looked at it and did a full review, and it took pretty much the entire 12-hour flight to go through it all, and it was pretty eye-opening.
Yeah. You mentioned that as well. Everyone's going to have different life circumstances.
Has to be taken into account.
100%. And like we were just having a chat on the way here, and my wife's been telling me about a budget for the last 4 or 5 months while we've been doing a renovation on a house that we're not living in. And once I started looking at the figures, it just felt like there was no point until we moved in and then we could start to do the budget. So
don't put your hand in the sand, because you know it wasn't going to be good.
Yeah.
But if you can't plan if you don't have the facts, and it's not always going to be what you want to see, and that's fine.
Correct. But then we were having a chat, and you said, look, there is going to be periods of your life where you will have to, that period for the next 6 months. Okay, you're going to have to dig into some savings, but know it's short term as long as you action your plan once your circumstances change.
Yeah, like I said to you during that same conversation, I've taken on credit card debt to get me through very small periods of time where I've had to be well and truly overexposed. But the other option was, if I didn't do that, I'd have to force sell a property that I didn't want to. And it doesn't mean you're going to take on that amount of debt forever. It's not part of your long-term strategy. You'll go through different periods where you're either too exposed, or you go through periods where you're like, okay, geez, I've been a bit lazy now. I'm underexposed. My money's sitting in the bank doing nothing. Now I've just been lazy. So it's just important to, and you don't know that until you check in on it. And like I said to most people, they should be checking on it every quarter. If you're not doing it every 6 months, it's not good enough, which I put myself in that category. And at the very least, just mark it in the diary, first week of January, every year, let's have a look at my position. Because for a lot of people, it's the inability to take action, which has cost them a lot of money in this market. They've been wanting to do something for 4 or 5 years, but they just get busy. You've got kids, which I get it. You've got 3 kids. School coming up, school holidays, it's crazy. And work was crazy during the year. There's always there's no time. There's no time. And all of a sudden you've missed out on 40 to 50% of the market because you're just too busy. You don't want to see people in that situation.
And that's the key thing. You need to know your numbers or regularly review your numbers, because when I went through this process as well, there was things I forgot I even had that that obviously were a debt that I had to eventually have to pay back. So I think it's definitely knowing your numbers and doing regular reviews.
What was that?
Oh, there's a credit card in the UK that I forgot about.
That'll get you.
A decently sized credit card too.
Yeah, right. Financial literature, Reece 101.
Okay, we've spoken on strategies, and there's a lot of different strategies there. I'm not going to go into what each strategy, because that'd be a 2-hour episode. Let's talk about yourself. We haven't really spoken about yourself on the 9 months we've been doing the podcast, but it'd be good to delve in. What is your strategy in 2026? You've mentioned you had a bit of a review on a long flight. You may be probably overexposed with some debt, and what's the strategy and where are you at the moment? Yeah,
look, I've openly talked, I've pushed my portfolio pretty hard in the last 5 years really, and particularly probably in the last 2 years, to the point where reviewing the numbers over that break, like I said, that 12-hour flight, I sat down with the numbers. Debt to income's between 8 and 9%, which is closing in on sort of double-digit numbers, between 8 to 9 times my debt to income, which is a pretty frightening statistic and probably got away from me a little bit. Cash buffer, which I talk about a lot on the show, and that's the ability to sort of weather any storms. So it's got to be above 10%. For the first time ever, it sort of slipped just below that. It was sort of closer to 9. And so you look at it, and for me, life's changing. Recently engaged, as we discussed off air, and the next phase of life is looking very different. So for me, it's priority for me this year is to wipe off the debt completely on my primary place of residence. And I've been kicking that can down the road because I've been expanding the portfolio and saying, look, I'll get to that. I will divest at some point. Now's not the time because the markets are running. So for me, 2026 is to implement the debt reduction strategies we talk a lot about on the show. It's like, how do you pay your mortgage off in 6 years? If I wipe it off this year, I purchased that or upgraded to that property in 2023, and hopefully, the plan is to wipe that debt off in 2026. So I'd be actually able to wipe off my prime place of residence debt in 3 years using the strategy that we implement with our clients, which would be not to say it's going to be done, but that's the aim for 2026. And that will give me a lot of peace in mind when going to that next phase of accumulation. Like I said, you go through different waves. I've gone hard accumulation. This year for me is going to be slightly geared towards debt reduction. And then I can then clear the air, be really, really comfortable that I've always got my home to fall back on. Gives you peace of mind. Gives your partner or your wife that peace of mind as well. And then you're back on the horse with that accumulation phase with your investment portfolio.
And how do you know which assets, the assets you should be looking to offload in 2026?
Good question, yeah.
Like we've spoken off air, you've got a portfolio, nothing crazy though. Like it's not a ridiculous one like you hear some of these investors out there.
It's not a $60-70 million portfolio.
But you do have, a substantial amount of properties. How do you know which ones are the ones you should be looking to capitalise and take off some of those gains?
Yeah, everything we do as a business, everything I do personally, Reece, is all about risk mitigation. So what assets do I think, if there was a stagnation or there was a cooling event of some description, which one would be the hardest to sell? It's counterproductive for what a lot of people think. Most people just look at what's done the most growth and what's done the least, and I'll sell the thing that's done the most, or they'll sell the thing that they've owned for the least amount of time. They'll sell the thing they've owned for the longest period of time and keep the thing they only bought 2 years ago.
Yeah.
Try to take all recency bias out of the equation. It's hard for me because I'm selling one that I bought 12 months ago, so I'll get the capital gains exemption. It was a really good deal at the time, and it's going to perform extremely well, but I only bought it 12 months ago. I've had things in my portfolio that I've held for 6 or 7 years. So for most people, they're like, I held that one the longest, and this one's probably the least performing in comparison to some of the others. But it's going to be the hardest to sell. It was a good deal, but we knew it was that villa unit style of market. That in a market would be in my portfolio, which is typically established houses, is going to be more difficult to sell, right? So that's how I approach what I'm going to divest.
Why is that? Is that due to strata or?
Yeah, exactly. So when the market's running hot like it is now, the blinkers are on for a lot of investors or owner occupiers to look past any potential defects, any potential restrictions with the property. So, but when the market cools, what happens? You see a lot of properties come on the market, supply outweighs demand. So people become extremely picky. So strata becomes a real problem to sell. Not always, and there's some good strata, and there's different types of strata, but straight away, anything that could be an if, but, or maybe, be that strata, anything that could be remotely close to a main road or close to commercial, anything that's now starting to age poorly, so it might have been built in the 80s, starting to get quite a bit of maintenance that's needed, that's enough for a buyer in a soft market to go, you know what, let's just hold off, we'll find something else. So those sort of things, anything that requires significant renovation, albeit maybe super blue chip, anything that might require serious renovation, do I do the works and activate that now, which I said I was doing with the Leaderville property, trying to maximize, but the key is still to maximize the exit value. So do all those things, put lipstick on the pig, all those sorts of things to maximize your exit. I'm not going to not do that. But if I'm going to divest, and we don't like selling, we spoke about it a bit on the podcast, but if I'm going to sell, I take all recency buyers out of the equation. Obviously, see how it impacts me from a financial point of view when you look at how much is it costing to hold this property on a yearly basis. The numbers are important, but most importantly, if in the unlikely event there is a stagnation or a global event, what is going to be the hardest asset to sell? And I start with that. That's my yardstick. And it often goes against the grain because, like I said, I'm selling something I bought 12 months ago, which I'd never do, but it's going to be the hardest to sell in a soft market. So I'm going to get that off the books. That's going to clear a little bit of debt. And there's another two that, may follow shortly after.
Yeah. And that whole strategy, as you mentioned, is to pay off your mortgage.
Exactly.
To have that principal place debt free.
Yep. I upgraded in 2023, took on an extremely large mortgage for my prime place of residence, well above the 3 times. When we talk about debt to income, we like prime place of residence to be less than 3. This was more than 3. And the goal was to pay it off in 5 years. And if the markets perform better than we anticipated, so by the end of this year, hopefully I've been able to achieve that in just over 3 years.
So your health check for 2026 then, where do you want to see yourself in terms of debt to income, cash buffers? You mentioned where you're at and how it probably got away from you towards the back end of 2025. Where do you see yourself?
I've set myself some goals. So to get my debt to income well below 6, ideally closer to 5. I don't think I'm going to be the type of person that's ever going to be below that. pay off my primary place of residence, so then debt to income on that is zero. Get my cash buffer up to 20%. Sounds significant, but that's a huge part of this equation. I really want to de-risk my portfolio. So that's a huge part of that. And just across the board, increase my rental income. So I was looking at the deficit. So negative gearing has formed part of my strategy for the last 6 years. That cash burn, has been significant and it's been, from a tax point of view, very beneficial, but increase the rental returns across the entire portfolio. And if I can do that by 5 or 10%, it's going to make a massive difference to the end of this year when I look at my repayments on an annual basis.
Okay. Yeah. So when you're looking at your property portfolio and you're doing an appraisal or a review, what are the things that you're looking at?
Yeah. So there's those really important indicators that we talk about all the time, right? Your debt to incomes, your cash buffers, those sorts of things. But there's also just knowing your numbers. Do you know how much land tax you pay a year?
No,
probably not. Exactly. So going in on that, what did you budget for? What did you forecast? And if you haven't done it, well, this is when you start. Throw in a number into your spreadsheet so you know what your numbers are. Don't go in blind. Everyone should know their numbers. What were the council rates? What are the true cost of what was the true cost of outgoings for the property or your investment property for the year, or multiple investment properties? So just checking in on that. And then where can I remove some costs? Is it having a conversation with my property manager to sharpen up their fees? Is it increasing rents? If you increase rents across your portfolio by 20 or 30%, all of a sudden your cash burn could be significantly less or could be in the positive. So you're starting to make money on your portfolio.
And just on that one, so you'd like to think, I've had good property managers, really good ones, and I've had some absolute shocking property managers. You'd like to think they're proactive in terms of coming to you saying, market value is this, let's increase. You're mentioning there, rent seems like a really effective way of increasing that, the revenue coming through. What sort of things should people be looking at to understand, is it undervalued or where's the rents at?
No one will care more about your portfolio than you. So don't assume that someone else is doing that. Assume the opposite. The likelihood is your property manager is doing the right thing and is out there chasing extra dollars, but assume they're not. Because you just want to be across it. And this is the time of year to do it. Go out there and get 3 other appraisals, see where it stands and see if they can increase. But it's also, you may not be investing in 2026, and that's completely fine. But if you're not, if a cosmetic renovation on one of my investment properties, so if I look at my portfolio, for instance, I'll likely sell 2, but I'll be updating at least 1, if not 2, to increase the rents. So it's where can I put in cosmetic works to increase the rent by an extra $100, $200, $300 a week, because I'm trying to reduce my cash burn. So it's looking at those things as well. Okay, if I'm going to hold this portfolio longer term, by spending $30,000 now to get an extra $150 a week for the next 10 years, okay, that makes a lot of sense. If it's not going to stay in my portfolio long term, well, should I just hold that money and not spend it? So they're the conversations you're having with yourself or your advisor about maximising your portfolio.
And a lot of those strategies, although you speaking about rates earlier, I got no idea what my council rates are. I'm not budgeting for that at all.
We would know electricity bill is.
Yeah.
We would know exactly. So but have it in there and put a prediction forward for the year. Like I said, it's like a good business. Everyone does their budgets. Do one on your portfolio. It's so important to know your numbers, not to put your head in the sand. And there's going to be things in there where it's a little bit uncomfortable. That's great because it starts to probe your thinking as we go into the year. And if you don't do it now, you won't do it. So kickstart 2026 in the right way. And it's not to chase this FOMO train. Just before you do that and read the back of the paper and the market's done record growth and you're like, oh my God, I've got to get in. And my best friend's just made another $100,000 in 3 months on another property. Before you get sucked in all that, know your numbers.
That was a really good deep dive into what you're doing, I guess, in 2026 and what are some of the strategies that you're implementing. What's the biggest risk mitigation strategies that someone can implement in 2026?
Start with your portfolio review. Look at it currently, do some forecasting, some budgeting if you haven't done that in previous years, and see where you're either over or underexposed. So knowing your numbers is number one. And then risk mitigation, if there is any speculative assets in the portfolio, it could be the time to potentially upgrade those. Could be potentially taking some money off the table to consolidate some debt. It could be, you've underutilized your portfolio. It's a time to potentially upgrade it.
I'm just going to end on what's opportunities. So that's going to be the last bit I ask.
To risk mitigate, it's knowing your numbers, it's doing your plan and starting to improve the quality of your portfolio. Right? And I think that's really, really important as we go into these periods of time where we've gone through 5 years of pretty strong growth nationally, is what do you want the portfolio to look like at the top of the cycle? what I want my portfolio to look like, Reece, is no debt in the prime place of residence, and my portfolio only includes A-grade blue chip stock. So what does that mean? It's divesting anything that could be or would be difficult to sell in different times when the market doesn't look as attractive as it does now. And that could be regionals, lifestyles, strata, compromised asset, main roads, those sorts of things. So if we're looking at de-risking, that's what I would be having those conversations with myself or my advisor around. What should I be keeping or including or buying in my portfolio?
Where do you see the opportunities in 2026?
In those areas, upgrading your assets, asset quality in your portfolio can and needs to improve in 2026. And that's the opportunity to do it. There may be some assets in there that you've bought on speculation. Like I said, some of the assets that I bought, they were just good opportunities, and the market was clear that different market segments were going to perform out of character, like the first home buyer market that was purely, built around this government grant. So when you see those opportunities, absolutely we want to capitalise on them. But is that going to be sustainable long term? Most likely not. So it's trying to reset your portfolio and upgrade the asset quality in your portfolio. I think that's the biggest opportunity in 2026.
Excellent. We spoke about 6 or 7 strategies at the beginning of the episode before we did a bit of a deep dive into what your circumstances are. If anyone has one of those strategies that they're implementing in 2026, let us know in the comments, because like I said, there's 6 or 7. That could be a 2-hour podcast.
Well, everyone's going to have a different strategy. I want to know what your strategy is.
And let's discuss. Let's review it. See
so
what
as
people are
listeners,
saying.
as viewers, can you put in your comment, what's your plan for 2026? And can you tell me, have you done yourself a review? I'd be interested to know how many listeners and actually check in on their portfolio to know their numbers. So have you done a review? And if so, what's your plan in 2026? I'd love to know.
So would I. You've been listening to the Folio Property Podcast.